Hello, everyone. Thank you for joining us on GuruFocus Value Insights. Be sure to subscribe on YouTube and Spotify so you never miss an episode. We are pleased to have Patrick Brennan, the founder and portfolio manager of Brennan Asset Management, join us today. Based in Napa, California, Brennan Asset Management uses a concentrated value investing strategy to manage separate accounts. It is also the sub-advisor for the Ocean Cross Capital Partners Fund. Patrick has appeared at multiple value investing conferences, including presentations to the New York Society of Security Analysts, the Nebraska Society of Securities Analysts, and the ValueX Vail conferences. He also co-authored an article on tracking stocks with Lawrence Cunningham for the Financial History magazine and was featured in a write-up of Liberty Latin America in the Private Investment Brief. Prior to founding Brennan Asset Management, he managed portfolios and led research efforts at two value investing firms in California, Hutchinson Capital Management and RBO & Co. Previously, Patrick worked at Mark Boyer & Company, where he led the firm's research team and helped manage $800 million of assets across individual portfolios, institutional accounts, and a mutual fund. He also worked for 6 years in investment banking and equity research with Dutch Bank, CIBC World Markets, and William Blair & Company. Thank you so much for joining us today, Patrick.
Great, thanks, Sydney, and thank you to GuruFocus for giving me the opportunity to present. Some basic disclosure, do your own research advice. Investments can move up and down, etc. You did a great job covering, sort of my background. Just, this is just one quick overview slide. Manage money on a separate account basis. I'll also do some company-specific special purpose vehicles. I own personally all the names, that I own for clients. I focus in on just a couple areas, generally financial services, the media telecom, and then some consumer discretionary. I don't do everything, well. I try to focus in on, just a couple niche areas. And I don't own that many names. The top, 10 or 15 names are 90% of the portfolio. And we're sort of looking for, attractive IRRs over a 3 to 5 year period. So I think, I'm gonna, on the next slide, I'll give an overview of what I'm gonna actually talk about. I thought maybe it'd be helpful to just sort of, quickly highlight the global themes I'm sure, most of you who are listening to this are very familiar with. It's sort of a narrow stock market, the, top, the so-called Magnificent Seven driving a large portion of the returns. I'd sort of, characterize this, there seems to be, a lot of excitement on artificial intelligence and all the productivity gains that can bring, but at current, a cyclically adjusted PE ratio, the market probably looks pretty elevated, among the highest in history. There's also a big debate on interest rates. 6 rates, big rate cuts at the beginning of the year, down to maybe 1 to 2, maybe it's 0, maybe it's an increase. What happens if rates go higher? And I think for a couple of the names maybe we'll touch on at the very end, maybe a concern on refinancing, or certainly a wave of refinancing to come. Where are investors avoiding? We're going to be talking about a couple areas, smack dab in the middle here. People don't, are uncomfortable with leverage. Generally, foreign names are less popular. Some of the names in Europe, the UK maybe in particular, are fairly bombed out. If you're smaller, there's a lot of research been cut across several names. Those pockets of maybe smaller names that are just not well covered, I would think would be misvalued. And certainly, big debate has just been sort of, most people have sort of concluded, and rightfully so in many cases, you'd rather own a great business at an average price versus an average, business at an extraordinary price. I think maybe the nuance is slightly more complicated, and I'd sort of frame it as, what about a great business at above average price versus maybe an average plus business at a bombed out price? And there, I think maybe the answer is less clear. And hopefully I'll try to show a couple names we own that we think the latter category is more attractive. So try to cover a couple topics. A couple of these we're going to have to go through reasonably quickly. You can always reach out to me afterwards if you have questions. We touch on European financials. It's one of the hardest hit sectors I've ever come across in my career. I think this is certainly financials in the U.S. have had their challenges with Silicon Valley Bank, et cetera, that most are probably familiar with. I don't think many U.S. investors appreciate how cheap European financials are. So maybe just some high level there. I had talked on the Irish banks, the last time in a previous presentation. I still like them. I think PTSB is the most attractive one of them. It's the smallest one. This is rather illiquid situation. We're one of the larger shareholders here, but we continue to see a substantial amount of upside. Talk about another unpopular. It's technically a UK bank, but it's really a payment processor. Cab Payments might have been the most notorious IPO in Europe last year. Had a huge stock decline. I think it's still a secular grower. With, I'll argue with incredibly attractive growth rates over time, trading very much like a European financial. And we'll just sort of touch on, I know I've spoken on the LATAM cable in the past, and I think we'll just, have a chance for, quick summary of those, at the very end. I can answer any follow-up questions. So on Europe, I thought a couple of these charts from Autonomous Research might be helpful. So this is just broad-based European financials on a 2-year PE basis. We've rallied a little bit to sort of really we're between 6 and 7 times, but we're not that far off valuation levels during COVID or kind of near the bottom of the GFC, and that surprises a lot of people. I think this has just been the long-term average PE of European financials has been 10 times, as we'll sort of show again. Period of Europe had actual negative interest rates, and so zero and negative interest rates clearly bad for banks. And I think there's just this muscle memory that people somehow think valuations are headed back to this level. I would argue if you don't think rates are headed back negative in Europe, it probably makes less sense to wait the period of roughly a decade when zero negative interest rates were the law of the land. The chart on the bottom is just trying to show expected profits as a percentage of GDP and the market cap of financials as a percentage of GDP, and going back into the mid-1990s. And as a percentage of GDP, even though absolute profits are at the highest levels ever, as a percentage of GDP, they're at very modest levels, and sort of something comparable with what existed in sort of the end of 2003. Not something where they were earning or over-earning, right at the heels of, right at the beginning of the financial crisis. And as a percentage of GDP, even though as a percentage of GDP, the profits are the same as they were in 2023, the market cap as a percent of GDP is half those levels. So again, I think it speaks to sort of bombed out sector. This is just a visual representation of interest rates. Again, I covered this. And again, you see a period where rates were negative. Rates are expected to fall in Europe, maybe 3 rate cuts in the back half of this year. But I don't think it was debatable whether negative interest rates actually worked. They probably did as much harm as any good. And most U.S. investors you speak with would sort of have a broad forecast, sort of saying, no, we don't think rates will go negative again. But yet again, you're applying valuations during a period of negative interest rates. And so here, maybe a final macro slide. This is just sort of showing capital levels. And this is particularly relevant when we get into talking about PTSB. But it's just one of the regulatory metrics that's most important for a financial institution. How much common equity does it have relative to its risk-weighted assets? And we'll cover this. I suppose right here, risk-weighted asset. The basic idea is $1 of treasury exposure is very different than $1 of commercial construction loan. And so that $1 may be weighted at sort of 50 cents for one exposure, might be weighted at 100 cents on the dollar for another. And the higher the risk weighting, the higher perceived riskiness of the asset. And so this is a metric that sort of talks about capital as a percentage of this. But as you sort of see, the line goes up and to the right. I mean, capital levels on a CET1 basis are at the highest levels in, what is this, close to 40 years. And also, if you just want to sort of a leverage ratio, sort of say common equity relative to total assets, again, also at some of the highest levels in the last 40 years. And the bottom chart is just sort of saying, you look at total capital returned, dividends, buybacks versus capital raised. You see again large numbers, the last couple of years, and forecast to go even higher. So huge, like bombed out sector, a lot of capital, and stocks and many of the companies are actively buying their stock. And I think that's a recipe for a lot of potential value creation. So on to Ireland. I'm going to quickly go through some of the just macro overviews and sort of the thinking in doing this is that if you're long a bank, you're kind of long whatever market you're in. You're kind of long that macro market. And, I would argue Ireland is one of, I think it's, I'm biased obviously, but I think it's the most attractive market in Europe from a 3 to 5 year economic forecast, from a demographic point of view. I think it's one of the most attractive in all the developed world. And a lot of multinational companies here are based in Ireland. And just a quick review of Ireland, they lost their collective mind during the global financial crisis. Bank assets were a multiple of GDP. This is an incredibly painful experience. So the government came in, had to guarantee all the bank liabilities. The IMF had to come into Ireland. The home builders all went belly up. And so you went, as a result of this, you went about 10 years with building very few homes throughout all of Ireland. And sort of, 3 or 4 years post-financial crisis, the entire economic outlook for Ireland drastically changed. The tech companies came to Ireland. A lot of them probably initially attracted to a low corporate tax rate, but they're also attracted to a very educated workforce, venture capital communities. Sprung up in Ireland. There's a lot of engineers that come out of Ireland colleges. You can, the government will finance education through graduate school. And so there became a, drastic need for homes. And so to put, some rough numbers on this, you hear a lot of stats in the US about shortage of homes. The shortage is very modest compared to what happened in Ireland. So there's no homes built for roughly 10 years. They got the home building up to roughly 30,000 units on this is a housing stock of roughly, call it 2.1 million units. It's forecast now with the job growth, with people, with the demographic trends, people moving back to Ireland, they're going to need 40 to 60,000 homes for maybe the next 2 to 3 decades. It's really an incredible number, and it's a lot of mortgages that are going to have to exist. So you got this real favorable macro backdrop, and then on top of that, you had a regulator in many ways that was fighting the last war, and so you have this. This is GFC was a real traumatic experience for Ireland, and sort of a vow of never again. And so Ireland imposed some of the most stringent capital requirements on the Irish banks. And after several years of negative interest rates, stringent capital requirements, 2 of the banks decided to voluntarily turn in their banking license, and that was Ulster and KBC. The important thing to remember is that these 2 banks were swallowed by the 3 banks that remain in Ireland. And for PTSB in particular, the acquisition of Ulster increased their performing loan book by roughly 40%. And so this was really, it was transformational for all of the Irish banks, but for PTSB in particular, this one was a game changer. So PTSB, you've got this favorable macro backdrop. You have, it got stale with the Ulster Bank. And as we're going to talk about, it has a risk-weighted issue that it just has not been updated, but should be by the end of next year. And it's among the cheapest bank in a bombed out sector. So I'm going to go through these next couple slides pretty quickly. This is just showing demographic trends. Europe is notorious for, slower growth. There's not as many kids and demographically less attractive, certainly than the US. Sort of see, annual, this is population growth, it's far less than 1% for the EU, close to 0. It's 1.3%, may not sound like a big number, but when you go over a multi-year period, this is actually fairly robust growth. Ireland, very young, a lot of jobs, and again, big, translates big need for, attractive place for foreign direct investment, attractive place, for a lot of houses that have to be built, and for a lot of mortgages. This is some broad economic stats. Not going to go through all these. The thing that's worth mentioning again is I don't think there's a single European country that would trade trade their own outlook for that of Ireland over the next 3 to 5 years from just sort of a macro perspective. GDP numbers in Ireland are skewed because of the multinationals. They have a big pharmaceutical presence. The big presence, as I've mentioned already, on the tech companies. And so the GDP from just that net trade component can go haywire from quarter to quarter. Aircraft leasing is a big sector in Ireland as well. So modified domestic demand is kind of like their version of GDP. And that's expected to grow, 2 to 3% could be upside for that. So very stable economic growth, over the next several years. It's worth highlighting too, in a, period of, budget, huge deficits that we're facing in the United States. I mean, there's record surpluses expected over the next 4 years in Ireland. And this is a big political issue in Ireland, exactly, how you spend that money, but, something in the order of 40 billion of surplus forecast over the next 4 years. Won't spend a lot of time on this. It was just sort of, think about Ireland as during the GFC as the United States on steroids. I mean, the drop was even greater. The rebound was higher. We're above 2007 levels. And maybe one thing that's worth highlighting is Ireland put in macroprudential rules in 2015. So by the rules of the central bank, you could not borrow more than 3.5 times against your income for a home. So what that meant was that even if a bank wanted to give the crappiest loans they possibly could, riskiest loans, etc., they were limited by macroprudential rules. When we talk about this capital relief for PTSB, keep in mind that 70% of PTSB's loan book now is from 2015 onward, and it's eventually going to go to 100%. And so that means that that you're talking from 2015 onward. This is probably the most favorable credit environment in history to write mortgages in Ireland. And so it's really a completely pristine period. Now, the 3.5 target, as I mentioned on the slide, was lifted to 4 times in October 2022. And part of this is just due to there is an enormous demand for housing. And this sort of speaks to it. I mentioned the 40 to 60,000 possibly needed for the next 30 years. There's very few homes across all of Ireland, not a lot in the secondary market. So this is sort of the number 1, 2, and 3 political issues in Ireland. And maybe one other broad difference between Ireland and the United States is just it's substantially cheaper to buy a home than rent. And that you hear housing shortage in a lot of markets, but the dynamic is not true. In many cases in the United States, significantly, it can be, depending on the market, it can be a lot cheaper to rent than it is to buy. But this sort of speaks to full-blown housing crisis, and why this capital relief for PTSB is sort of a political issue for Ireland as a whole. They only have, there's 5.1 million people, there's 3 banks left, and one of them, PTSB, has one arm tied behind its back because of an antiquated regulatory issue that's in the process of being fixed. But they need the banks lending as freely as possible, and to for as many mortgages as possible, to remedy some of this housing crisis. So these are the 3 banks. It's Allied Irish Banks, Bank of Ireland, and PTSB. The other 2 are 3 to 4 times larger than PTSB. They have some clear scale advantages. They have advantages over. I think they're both very reasonable banks. They're attractively priced. Have selectively owned both of these. I think the more attractive investment at current times is PTSB. PTSB is a pure play. It's all Ireland, and it's also it's predominantly a residential book, although the SME, small and medium enterprise business book, could grow to sort of 7-8% of the book over the coming years, thanks to the Ulster acquisition. But the other important thing to note is PTSB, unlike the other 2, has 0 commercial real estate exposure of any kind. And so, again, if you like Ireland, you buy into that you need a lot of homes in Ireland, and you buy into, this is an attractive valuation, they're going to get some capital relief. I think this sets up well for the investment. This slide might be a little more difficult to read, but it's, again, this is a function of only 3 banks in Ireland, and the so-called deposit beta that a lot of investors, financial investors in the United States talk about. It's the amount that deposits increase as a percentage of in the U.S. Fed funds increases, in Europe for ECB deposit rate increases. Ireland, with only 3 banks, is the deposit betas have been much, much lower. And so PTSB, from what we can gather, their forward guidance is assuming betas ultimately move to sort of 40 to 50% on paying deposits. I think this is an exceptionally conservative assumption, given that underlying deposit betas really haven't cracked 10%. And again, in Europe, bombed out sectors we sort of talked about, but it's a consolidated sector. Here we only have 3 banks with 5.1 million people. You don't have a Treasury direct like you do in the United States. It's more cumbersome to move your deposits. You don't have 4,000 plus banks like you have in the United States. And in Ireland, you got a pretty substantial tax on any of your interest income. So PTSB has a really attractive deposit franchise. Their deposit guarantee scheme is capped at 100,000 euros. 70% are covered. It's even higher on a retail deposit format. So we would argue just the nature of Ireland and the attractiveness of Ireland, plus this deposit franchise, makes PTSB a pretty interesting acquisition candidate if the earnings potential that we foresee doesn't ultimately materialize. But we think they've got a pretty good story on that front as well. So this is, I'm going to spend, I'm going to go through this kind of quickly. It's a little technical, but I can get into the, any questions in the Q&A. But this is, we covered risk density. This PTSB, the one on the left, that like crazy high black line, that is PTSB. Ireland is a lot higher than the rest of Europe, and PTSB is ridiculously higher than the other 2 banks. And this is one of the key parts of understanding the PTSB investment thesis, is they are far more overcapitalized than first meets the eye. Their target CET1 to risk-weighted ratio is 14%, which is high. But there's a lot of other banks that have CET1s in that ballpark. What's different is that the density of new mortgages is 55% for PTSB versus something like 32% for AIB, 22% for Bank of Ireland. The AIB and BOI ratios would be up to 2 to 3 times the density of other countries in Europe. And as we just went through, from 2015 onward, Ireland is about, it's just an incredible market to have been writing mortgages from. So why did this happen? Well, there's a process that called the Targeted Review of Internal Models, TRIM process, that the European banks have been going through. For whatever reason, PTSB was the first of the 3 Irish banks to go through it in 2015. A lot of the models that were given to the Central Bank of Ireland were only updated through 2013, before the macroprudential rules came into effect. Some have been, the central bank has the models from 15 to 17, but the important point is the other banks are updated through the end of 2023. So you can't have 2 banks that are updated through the end of 2023, incorporating a much larger period of very positive underwriting data, and one that is sort of stranded at pre-macroprudential rules. So currently, the central bank has agreed that this needs to be remedied. PTSB, this is a massive project. You've got to submit all of the models. There's thousands of pages of code associated with each input assumption. The expectation is by the end of 2025, there's going to be a fairly material reduction in the densities. Now, they're not going to go as low as certainly Bank of Ireland or Allied Irish Bank, but interestingly, over a longer stretch of time, all 3 should converge. So the actual effect could be much larger than what I'm going to talk about. But the punchline is, between organic capital generation and the density reduction, we think that of the amount of excess capital above the 14% CET1 ratio, it could be 50 to 75% of PTSB's market capitalization. It's a huge number. This one is just going to sort of say, if you want to assume incremental funding term costs at 2.25%, which is a higher number, way higher than their existing funding ratio right now. But if you sort of said, I write a mortgage at 4, at 2.25, I've got a mortgage I've got to put aside 55, it's weighted at 55%, so it's 55 cents of actual exposure. I've got to put capital, again, 14% against this. If I make a series of assumptions, right now the incremental return on that mortgage might be 18-ish%, while an SME loan could be something closer to 19%. So until PTSB gets relief on this front, It does affect their ability to aggressively court market share in Ireland versus the other two, and it causes them to lean in a little bit more to the SME loans, even though an SME loan might be weighted at 90%. So this is the distortion it causes. If I change for the next slide and sort of say, okay, let's take a guess on where the density on mortgages might move to, something closer to 33%, down from 55%, the incremental return on your mortgage jumps to like 30%. And so this is a massive change. And obviously, it's ramifications for how aggressive PTSB can be, going after market share. We sort of say that, like, their shares hovered between 16 and 18%, around 16-ish% now, as they're kind of pursuing more SME loans until this relief goes through. We think it can move into the low 20%, driven in part by this change. So I'm not going to go through every detailed model assumption here. I'm just going to cover the, I know some of you are probably signing relief on that, but like what I would sort of say at the highest level, look, 3 banks for 5.1 million is a lot easier than 4,000 plus banks in the United States. I've got 330 million people in the United States, but just the ratios are much more favorable. I think it's a lot easier. And again, to the original point on average plus businesses, the bank might be an average business, but if there's only 3 of them for 5.1 million, I think you got a good chance at an average plus here. I think ultimately they can earn a 40 cents plus of earnings potential, stock at 150 to 160 euros. The updated PTSB, from the last time, stock has weakened. They sort of updated their guidance, sort of forecasted 2026 earnings of roughly 30 cents a share. If I'm completely wrong, that guidance is accurate. It trades at 5 times that number, 40% of tangible book. I think the number is closer to 40 cents, especially since subsequent to their Q4 earnings release, there's 2 worthwhile points pointing out. First of all, in Europe, you have to issue a series of senior debt. It's called Emerald debt. It's sort of, I mentioned the CET1 capital ratio. You have total capital ratios that incorporate essentially the senior bonds of the bank. PTSB just issued senior debt in early April at 4.25%. Now, if you trade at 40% of tangible book value, that implies a cost of equity ratio, probably something north of 20%. And almost the valuation suggests that like maybe you need to raise capital, or that there's some sort of capital deficiency. We just went through why that we think that it's actually the polar opposite of this. There's about to be a catalyst that's going to unleash a lot of excess capital. But even trying to square the 4.25% versus 20% cost of equity is really, really challenging. We joke either the debt investors collectively lost their mind early in April, or the equity is massively underpriced. And we're kind of in the latter camp. Went through the excess capital. And then the final aspect of this story is, this is a very limited float. And again, like, do your own diligence and keep this in mind. If you're trying to buy shares, even a retail investor would have some trouble, buying a meaningful position in this, given the illiquidity. The government still owns 57%. NatWest owns 12%. NatWest is that is Ulster. Ulster, as part of this deal, they received shares in PTSB. NatWest was, amazingly, it's a UK bank that they were bailed out by the UK government in the process of selling their own stock to the public, getting the UK government out. The PTSB position of roughly 100 million euros, it's just insignificant relative to the total asset size of NatWest. There was a sale last year. The government went down to 57%. They were higher before, as was NatWest. They sold share for share. We think there's going to be another share sale sometime this year. Other large shareholders, ourselves included, as part of that 15% bucket, your actual freely tradable float is less than 150 million euros. So this is, it's a smaller name, but I think, it doesn't take a lot of imagination to think of a time when the free float is increased. The government is completely out of Bank of Ireland. They've reduced their stake in AIB from, it was over 70% a couple of years ago. They're down into the mid 30s right now. They could completely exit AIB within 2 years. The process is going to repeat, we think, with PTSB, and it would repeat at the same time you have the capital that is reset via the relief effort I talked about and the manifestation of this earnings that we see. And the dividend blocker that existed on PTSB was lifted at the end of last year. So, if we're directionally correct on, 40 cents of earnings, 30 or 40 cents of earnings, you're talking about even at a 50% payout ratio on a dividend, that could be 15 to 20 cents of dividends. And obviously you'd buy back stock versus doing a dividend at current levels, but it's not going to trade at, sort of a 10 to 15% yield over time. And so I think it's just the progression over time that re-rates this. And ultimately, if we're wrong on the degree of upside, we again would sort of back up and say Ireland's a real attractive place to be. It's cheaper to buy PTSB than it would be to try to build a franchise from scratch. So for those who want some more details on this, please give us a call. So we're going to cover two other topic areas, which I hope Sydney's not too terrified by here this presentation, but I want to introduce another in sort of this one I'd firmly put in the average plus two, I would argue a out and out good business. And this is sort of a situation that's notorious in Europe that I think is really attractively priced. So what exactly is CAB Payments? This is a UK bank. It's been around for nearly 200 years. They used to be an arm of the government processing, payments. The sun never sets on the British Empire, and this was ultimately privatized, but it has its sort of tentacles in all parts where Britain had historically existed since 1833, and this includes a large presence in Africa. This sleepy bank was taken over by a private equity firm named Helios Partner in 2016. They pivoted the bank towards foreign exchange and payment processing, and this pivot has been wildly successful, as we'll show. CAB Payments, the core thing, what they do is they provide hard currencies to emerging markets. So this is kind of a key point. So hard currencies, dollars, euros, pounds, predominantly, those three, and they are acting as a middleman. If the United Nations wants to send aid relief to Nigeria, maybe they'd go through CAB Payments to send dollars to Nigeria. And CAB Payments, because of their extensive relationships within Africa, might be the best position to get the most favorable rate on the Nigerian Naira local currency. That's what they do. And I just sort of point that out because all the sort of scary headlines with emerging markets, devaluations, etc. CAB is not exposed directly to those risks. They are acting as a middleman for this, and you can actually see it in the lower risk weighting that is actually assigned to this particular business. So we think they have we'll sort of talk about, they have a very small share of an enormous market that's growing rapidly. There was a lot of hope around CAB Payments. It was, as I mentioned, I think at the beginning, the UK markets, even by European standards, are trading at some of the cheapest valuation levels. CAB Payments was considered the big hope of the fast-growing fintech company coming to the stodgy UK market. Forecast huge growth rates, 45% in 2023, 35 to 40% thereafter. These are top-line growth. They had flagged sort of Nigeria as an area of potential weakness. And then on October of 2023, they blew up. They had to revise their guidance downward. They had problems in two of their currency corridors that after the fact probably were not as bad as was maintained at the time. The problem was CAB thought there was going to be big growth in those markets. Stock declined 70% in one day. It's kind of a staggering move that happened. And, for those who read the Financial Times thought that, CAB didn't disclose some of the volatility in their businesses as well as they should have in the IPO prospectus. But just with this movement, it's high-profile IPO, blows up. You had investors who were in this, they just can't own it after that percentage decline. A lot of people sell it out. The sell-side analysts are no longer confident, in their numbers. And just what you create is, so this is a very small market cap, but the fundamental growth outlook may not have changed that much. And you still could have, it's very possible that growth could be something closer to 20 to 25-ish%, maybe. Maybe it's 30%. It's really hard to be precise on these levels, but it's still probably a very attractive grower, has no debt, it is a bank. It has incredibly high. It has a 25% CET1 capital ratio. It's going to generate excess capital, and it's priced like a European financial. And so I would just sort of argue that if growth returns even close to the current pace, to prior forecast pace, you could have this dynamic that growth is strong and you have a re-rating on top of this, as capital is generated as well. So you could there is the potential for, multiple turns of upside from here. And I would argue downside is limited by the current valuation. So we're going to flip through a lot of these fairly quickly, and I'll just come back without questions. I sort of described what they do. Their competitive edge is for anybody who's tried to wire money from the United States, maybe your local bank in, pick a city, Atlanta, Georgia, and you're going to go from Atlanta, Georgia, and you want to send something to Africa. Your local bank is going to have a correspondent banking relationship with another, probably large. It might be one bank who has the relationship then with one of the larger multinational banks, the Citigroup, JP Morgan. JP Morgan Citigroup would have a correspondent banking relationship with a large bank in Africa. The bank in Africa could have a banking relationship with multiple other local banks within Africa. So that's multiple point-to-point. CAB offers, because of just history, 200 plus years operating, for the British Crown, they have bank accounts throughout all of Africa, and they're a regulated bank. And so what this means is they can open something called a Nostro account, which is a foreign currency bank, a foreign bank account at another bank in a different foreign currency. And they have these throughout all of Africa, and they have one of the largest payment networks throughout Africa, where they can get some of the most favorable FX transactions. And where the rubber meets the road is that ultimately the correspondent banking relationship is much more expensive. They might take 5% of the total transaction. CAB is taking 1/10 of that, and that's an enormous opportunity for market share gains over time. The other thing worth noting is correspondent banking. It's not really a focus area for the largest banks. In fact, one of the fastest growing customer areas for CAB payments is actually multinational banks, including Santander, Citigroup, et cetera. And so Citigroup might be able to quote, with a markup to the CAB service, rate for exchanging currency or making payments, and it's beneficial for them because they don't have to worry about the regulatory risk. And again, a Nostro account, an advantage as a bank that banks can open these, tech companies cannot. And so it's much, much easier. You don't need the central bank approval of Tanzania in order to open up a Nostro account. You would potentially, if you're going to do foreign currency and payments in that country without a Nostro. So global payments, 271 trillion. The CAB is targeting just a fraction of this, 1% of this market. That's still 2 trillion, and they have roughly a 1 to 2%. So their basic model is there's a certain amount of flows. They have a take rate of those flows. And if you look at it in terms of the flows or the actual revenue, it's roughly 1 to 2%. Again, here is the, in that targeted pool, it's, 6 to 7 billion, and, our revenue stream within this 1 to 2%. It's a huge market, still, growing, and CAB's taking share. The major market customers on this for CAB payments are non-bank financial institutions. This would be a lot of people are more familiar with, something in Europe, a company like Wise, which is like a consumer-facing payments company, is a customer of CAB payments. And a lot of these B2C companies who, one of the confusions that CAB has is, well, how do you compete with Wise? Well, actually, they're a customer because it's cheaper for a lot of these tech companies for some of these corridors to go to CAB payments, where that last mile is far cheaper for CAB to process. International development organizations, the UN is a client of CAB payments. There's some sensitivity. CAB can only selectively disclose what its clients are, but sometimes the client itself discloses, and that's why some of these clients you're able to talk about. And so, it's not an easy thing to get on the United Nations, client roster, but, they're a massive sender of, aid packages, to Africa, and not really a cyclical sender in some ways. And then one interesting aspect is if you think of like, some sort of crisis, a coup, devaluation, some negative macro event, a lot of times there's a counter-cyclical aid flow into these markets. And so maybe counterintuitively, some of those events open up potential for FX transactions, which CAB can maintain. The other two that, emerging market financial institutions, a lot of the large central banks of Africa are clients, as are the African banks themselves. And then major market banks, Citigroup is believed to be a client. Santander has publicly addressed that this is a client. This is the smallest client base for CAB, but it's also the fastest growing. So up there, I mentioned, 509 clients. They, have a big roster, and the retention rate is over 100%. What does that mean? It just means not only have you kept customers, that means the customers that you have are actually doing more businesses. And typically what this means is they'll start using CAB for one corridor, and then they'll switch to use them for other corridors. Maybe they'll start in Africa and they can go somewhere else. And one of the other questions, I'll just sort of address it, right now, is like, well, can they only do Africa? Well, they also have Brazil has been a market that they've been expanding in. They will expand into North America, as we talked about. And if you have the customers, they have flows. And so, maybe the UN is going to use CAB initially to get money into Nigeria, but they have aid flows all around the world, and they've operated with them in one market. And typically you start in one market and you grow in other markets over time. This is just quickly, so from 2020 to 2023, it's not quite a five-fold increase in income, but something close to that. And it's huge margins, a lot of very, very high cash conversion in these markets. So it's really an attractive little business. And so here at the macro, at the highest level, the 2.3 trillion. There is volatility in these numbers, and I'd sort of say these were originally McKinsey, numbers at the time of the IPO. There's SWIFT data that is not complete, that was sort of cited in some of their earnings presentations. But the highest level is the market's probably, for the specialist, is going to grow at something like 20%. That's 5% underlying growth in just payments in general, and then the specialist firms like CAB taking share from correspondent banking. And correspondent banking is down by, I want to say something close to 20% over the last, kind of call it 5 or 6 years in Africa itself. And so these specialists, it's just irrespective of CAB taking additional market share, the headline opportunity is somewhere around 20% underlying growth, which is really an attractive overall market. And this is just sort of the take rates for their market. Again, you do volume, you take a take rate here. The thing that's probably to note is emerging markets, the take rates, can be up to like 9 times that of developed markets. And so CAB probably has a focus in the developed market area, but they also do some developed market currencies as well. So this all sounds wonderful. But I mentioned the stock declining 70%. So what exactly happened? Again, they flagged the problem with Nigeria at the time of the IPO. And what happened? Nigeria, like a couple of markets, there's a set FX regime that sort of exists for most goods. And then because there's a shortage of hard currencies, and in particular dollars, there's sort of a black market rate. And what happened from 2020 to 2022 is there were still strong flows of remittance, aid, other foreign transactions that occurred, but you had a big divergence between the official rate and the black market rate. CAB was able to source local currency at the black market rate while volumes were still strong. So they had this period of super profits that existed in Nigeria. They flagged this at the time of the IPO and said, this is not expected to continue. But it probably ended up a little worse than what they thought, but it wasn't the primary driver. But this is something that's sort of flagged. Nigeria is the largest economy in Africa, going to be probably, the largest in many years. This will be a major market. It'll probably be something closer to 7%. It's worth noting that there was a change in administration in June of last year. There's been 2 devaluations in Nigeria. Again, sounds, scary headlines. This doesn't affect, it's not a existential risk for CAB, but volumes haven't been as strong. The currency's been more stable since March. Nigerian naira, it's actually, I believe it's the strongest currency in the world since March. Volumes have returned. CAB is forecasting essentially no growth. I'm sorry, not no growth. They're forecasting for 2024 volume or revenue in Nigeria may be 70% below what it was in 2023. But what the key point is, if you X out Nigeria in 2023, the headline payment and FX growth was close to 30%. So this market, once Nigeria stabilizes and likely grows, I think that you're going to see the stronger underlying growth for CAB as a whole, just mathematically from that dynamic. The problem in a day, there was 2 corridors, the Central African franc and the West African franc. I know a lot of you probably totally unfamiliar with 2 corridors. What essentially happened, there's a dollar shortage, and the central banks decided that they're going to make it more difficult for outside firms to earn a profit bringing dollars into the country. And measures were taken. The mistake CAB made was, again, I sort of mentioned that they start new clients with a couple of corridors where they, they're particularly active. These were 2. The restrictions came in right at the start of the 4th quarter. It's a heavy remittance quarter, and they had to give an update, and they were assuming growth in these corridors, and they were restricted from operating here. And that decline is what caused them to revise down their forecast from the levels that they had just reaffirmed a couple months earlier. Since that time, the second one of these, the ZOF, has stabilized a lot more. A lot of the restrictions have been left, are no longer present. There are still some in ZOF land, but this is probably a much lesser issue than existed in October of last year. Not just going to sort of talk about, Nigeria is, again, I mentioned that for 2024, it's expected to be at, roughly 1/3 the level of it was in 2023. ZAF and ZOF are expected to, rebound to be something like, they're going to be top 5 corridors, but the overall growth for CAB for next year might be something closer to 10-ish% versus, I think, levels that, of the higher levels that I mentioned before. But if you strip out Nigeria, it's very possible the growth in their core business is closer to 30-40%. One last thing that's worth mentioning, and I'll just do it here via, these are my projections and sort of, what the business would look like. CAB actually has a very attractive deposit franchise. As I mentioned, they were a lot of the accounts that they have, Nostro accounts they have in Africa, their clients are just looking for exposure to dollars. They're not trying to get the strongest possible interest rate. The deposit franchise for CAB is probably going at 3 to 5% per year. They benefit from higher interest rates that they earn on those deposits. And so the net interest income is, benefits from higher interest rates. And so this is another attractive aspect of the story. To the 2 other recent updates they've had, I mentioned the strong customer growth that they've had. They just recently received a Netherlands license. Again, UK company, there was Brexit restrictions. They actually couldn't call many financial institutions. They could receive calls about their services, but they couldn't make inbound calls. That license was supposed to happen at the end of 2023. There was probably some investor concern about this. It's officially granted in April of this year. They're going to have a similar license it's called a representative license in the second half of 2024. This would allow them to directly call on regional and national banks in the U.S. and went through a pretty big deal. The last thing I'll sort of mention here is there's something called the chip systems, and this is the biggest potential upside from CAB, even in spite of what I just mentioned. This is the clearinghouse interbank payment system. This is dollar payments. You have to be a member in order to process dollar payments. So if Rwanda wants to send dollars for a particular payment, they're going to have to go through a CHIPS member. CAB has a custodial banking relationship with the likes of JP Morgan, Citigroup, But JP Morgan Citigroup have restrictions on, how much dollar payments from Rwanda they will process in a given day, month, period. And so CAB probably leaves a lot of money on the table. This license would require them to get their ownership level down. That you couldn't have an owner above 25%. Helios owns 45%. When CAB decided to IPO, this was one of the primary reasons why they decided to IPO versus sell the bank, is because the opportunity to potentially get chips would be such an enormous, revenue upside over time. I think this was behind the thinking. There's several ways this could evolve. They could end up buying in stock. Helios sells into a buyback. Helios could sell their stake to a couple of other players who are below the 45%. This is probably a 2-ish year opportunity over time, but I think it's just worth mentioning. So, I would sort of characterize it, probably say conservatively, growth outlook, maybe 25-ish% top line. I think post 2024 is very realistic. I think it could be faster than that. And it's trading at something in the order of 5 to 7 times its projection. So I think that's a real attractive setup for those who can deal with illiquid, unpopular stocks and take advantage of the complete turnover of the shareholder base. So I'll talk about the risk in a second. This one we'll spend just 2 minutes on. I did mention, switching gears, LATAM cable remains as unpopular as ever. I sort of mentioned 3 names, I believe, in the last update. I think 2 of the 3 have gone incredibly well. There's a lot of potential in the third. But Millicom, starting in the middle and the bottom, Millicom, an activist investor named Xavier Neal owns nearly 30% of shares, just under 30%. At 30%, you'd have to make a tender for the entire company. They did an attractive acquisition of Guatemala, the 45% they didn't own. The mistimed, poor execution on the rights offering that ultimately priced at $10. Xavier Neal has helped drive a lot of progress. They've doubled the cost savings. They're expecting $550 million of free cash flow this year. Trades at 6 times this number. Leverage is expected to fall to 2.5 times. So I'd say this one's going really well. I think it's materially mispriced at current levels. Megacable is a Mexican cable name. They've vowed to double their footprint from 9 million to 8 million, 18 million homes. They're most of the way through this at this time. Penetrations seem to be progressing well. They're 13% now. In the older cohorts, so 20-25%. They could do this because they were one of the only unlevered names in all of Latin America. So the rollout's going well. Their competitors are hamstrung because of balance sheets. Trades at 4 times 2024 EBITDA for something that could very well grow EBITDA 10 to 15%, maybe 15% plus, on the timing of these rollouts. Lilac has probably been the one on an operational basis that the execution's been lacking. It's been a little disappointing. It all is, they did this massive deal for AT&T's Puerto Rico wireless business. Wireless business has probably been hit a little harder than they thought from T-Mobile competition. It's taken longer to get off of transitional service agreements with AT&T. That's all expected at the end of this year. They need to execute here, and they've given kind of bold claims on where the synergies, the cash flow numbers are going to be. But, investors sort of have to see it. And I'd sort of, honestly proclaim that this is the one that the operational has to improve. That said, this is a $1.5 billion market cap company. They said they're going to generate $1 billion of free cash flow over the next 3 years, even assuming that they have to refinance some of their debt at higher prices. John Malone just recently bought $10 million worth, right around, it's not that far from current levels. So again, not going to have time to go through all these, but I just wanted to flag them quickly as we had talked about them in the past. So with that, I'll pause and allow material, and happy to answer any questions.
All right, thank you so much. During your presentation, you discussed some of the disadvantages of the European banking sector, like compared to the US and vice versa, and how permanent TSB appears to be at an advantage currently, especially in the Irish market. Are there any areas in which it is at a disadvantage compared to other European operators and US operators? You mentioned the risk weight density, but is there anything else?
Yeah, I'd certainly say the number one, one of the issues, I'll give I'll zoom out for a second, then I'll go back into the PTSB. One of the issues I think that U.S. investors have has just been the regulatory apparatus in Europe that's been considered more hands-on. I'd sort of say, over a couple of cocktails, it'd be more described as something like, a bunch of socialists and, a restrictive campaign and, out to get, their European banks. And part of that, understandably, I think during COVID, the European banks, stopped, dividend payments to their name, just, a full stop, and, we're going to build capital now. So more hands-on capital restraint would be one of the common areas that you would sort of hear. And so harder to release capital. Now that has changed, and we sort of showed those, the chart on, the projected buybacks over time. But that is probably, something to sort of flag is like when you hear something, that's more negative about the U.S. about Europe than the U.S. But that actually could be flipping around a little bit, and the U.S. banks are about to get something that is more regimented. For PTSB in particular, their disadvantage is just scale. I mean, I sort of mentioned it was 3 to 4. The two other banks are 3 to 4 times larger than PTSB. They have an advantage on their funding costs is even cheaper. They have more dominant market share. They have on the SME side, they have sort of an 80% plus market share. And so again, these are huge, scale advantages. And so some of the fixed costs that PTSB has to absorb, they can't spread it across as large a revenue base as the other two. And certainly that is worth highlighting. The counter to that, though, is just from the starting point, you just don't need much progress on these, on a couple of areas to really materially move the needle for PTSB. In fact, the SME share is something that, there's a lot of businesses who they would like nothing better than to have a competitor, a third competitor, rather than have a choice just between, AIB and Bank of Ireland. And, if you can just offer any type of credible offering, you've got a chance. And so they have a chance for, the SME for just a little bit of broader market share within that market can be really meaningful for moving the needle. And, there's a pretty good step up in interest rates, from these SME loans. So I think that's one area. Then the second one is just, as I sort of said, PTSB is a very, very different competitor if they just can compete something closer to the other two banks from a mortgage density standpoint. I mean, that difference in densities is really pronounced, and if you just narrow that a bit, they're going to have an opportunity to offer, slightly, more competitive mortgage rates. And again, similar dynamic that, smaller bank, easier for them to, to win on servicing, with the typical customer. They just, it's like they have a chance to marginally increase their share, but the total pie should grow meaningfully over the next several years. I mean, if you're talking about a mortgage market that maybe generate 13 billion of new loan growth this year, to get up to 40 to 60,000 new homes, you could have a mortgage market that has to grow 50% on an aggregate level. So the other two banks can still do very well, still have more scale than PTSB, but just marginal improvements for PTSB can be much more meaningful. And at this starting point, from a valuation, from from future capital return perspectives, I mean, when you start figuring in buybacks into those numbers over time, could add a meaningful amount to overall EPS. I think just on the margin, from a starting valuation point of view and from a change in the business, that's what really can move the needle for PTSB.
All right, well, thank you so much. Also, when you were discussing CAB payments, you mentioned some of the challenges it's had to face, like with Brexit and, not being able to call up banks in other place that they had to like wait to be contacted. How would you characterize management's like performance in handling or navigating the challenges it has faced?
I'd sort of, I think it's very fair to say that they really, you give them very low marks for forecasting, the consistency of their revenue. I think what they probably failed on is just to mention that growth is not linear. And the dream of all investors is to have the secular growth story that like is the same quarter over quarter. You never have to worry about it. It's at a fast rate and it goes, and it's just not life. And I think maybe the dynamic that happened was, you can make a debate. The Financial Times would argue that they should have had more robust disclosure on currency corridors. There could be changes and restrictions, et cetera. And, CAB sort of said that was disclosed, and there's probably not enough there, one way or another. I would just sort of say that, like, they've proven growth is nonlinear. But where you'd sort of give them higher marks is that, like, this is really impressive customer growth that they've had and that they brought on, and you have to give them credit from the very beginning to see this opportunity to, like, the bank's been around for 200 years, and like this, I doubt it's had this type of period of revenue growth at any point in its history, and it was just this pivot towards foreign exchange and payments to a market where it has a lot of what you'd want in a younger growth company with huge market. You've got a tiny market share. You've got a competitive edge in this little kind of sector of the market, and it grows a bit over time. And the revenue numbers that I threw up for it's tough to go through all those, I know, in detail, but they're what they're shooting for 5% of their targeted market by 2027, and that would imply actually FX and payment numbers well above what I showed there. So I would sort of you'd say that the pivot has been good to this business. I think identifying the opportunity, the actual guidance that they give, should they have given guidance, at all, etc. You'd sort of say 4 marks there. Now the movement into other markets, into North America, into Latin America, still you'd probably honestly say to be determined. I mean, there's a huge amount of potential. It's easy to see this, but the proof will be in the pudding. So this will sort of play out over a couple of years to give a more complete answer.
All right. Well, thank you so much for that insight. In your fourth quarter letter, you discussed how some of these Latin American cable companies, like Liberty Latin America, Mega Cable, and Millicom, they've had their operational performance has not met expectations. Could you expand a bit more on where they have fallen short and what they need to do to improve?
Yeah, as I sort of mentioned, I think we've seen, I think where the operational performance probably would apply more towards, it was Millicom and Lilac. We've sort of seen a more pronounced turnaround at Millicom, and Millicom really probably the trigger being an activist came in. I'd say at Lilac that it's been a mixed bag. That they, as they sort of to quickly on the entire history of this came out of Liberty Global. They did a big deal out of the gate with cable and wireless, and they overpaid. The current management team at Lilac had nothing to do with the acquisition. They were brought in after the fact, and you give them really high marks for turning around cable and wireless. And in fact, the margin progression in that business has been well above what I thought it would be. Where I'd sort of say you'd question a bit more is just the execution within Puerto Rico. On the fixed side of the business, on the cable side of the business, this has been it's been a strong business. They've taken share. They've done better versus AMX is actually their largest fixed line competitor in Puerto Rico. It's been on the wireless side where I think that they've struggled. Now they would tell you it's been because they've been in the shackles of the TSA agreement. So that means AT&T has essentially they have to rely on AT&T for the core part of the network of their business. And so they don't have the flexibility to change around the pricing of their offering. AT&T, they have to go back through AT&T to do this. This is a very bureaucratic process. I think it'd be fair to sort of say they thought they acquired this business at a really, really attractive multiple post synergies, and maybe they underestimated the AT&T, doesn't have the best history of selling assets. I'll put it kindly like that, but they may have pulled one over a little bit on the nature of the deal requiring a 3-year TSA that had to be extended. I think was a disappointment, and because like what the investors are waiting for is to just sort of see the $70-80 million of synergies that are promised in Puerto Rico have to come through, and you have to get out of the TSA in order to have this happen. They claim it's going to happen. I would blame them some for the slippage of this timetable, and just sort of say, you have to see they absolutely have to execute on this from a credibility point of view. And so I'd say that's one aspect, and then the second one is with the shares just bombed out, 1.5 billion market cap, $1 billion of free cash flow. They have to just be decisive on repurchasing stock. And they probably, their target leverage is probably closer to 3.5 times. They're a little over 4 now. They'd like it to go down a little below this level. They had to convert that they were paying off for this year, and then they don't have another major maturity until 2027. So they just have this window that the cable business can support a lot of debt, and the interest rate environment has changed a bit, but if they sold themselves to investors as a levered equity model, and like the equity is at bombed out prices, and they have to be decisive in stepping up to the plate and repurchasing shares. And I think they fundamentally they seem to, there's been this a little bit of a tendency to talk a little bit about how cheap their stock is versus stepping in and purchasing it. And I would argue that investors, I think, have to see progress on both those fronts. And so maybe that's a little more helpful insight, on sort of what I see, at least from Latin America.
All right, thank you so much. Kind of shifting focus a little bit. How, if at all, has your approach been impacted by the market environment so far this year?
I don't think it's changed much. I've sort of, I think investors need to be pretty humble about their ability to, predict macro economic events and, interest rates. I think in some of the past letters, I've noted that there was an IMF study that they had 2 economists who were, looking at the blue chip series of economists and having them predict, what percentage of them, going back over, umpteen years, had predicted a recession 1 year in advance. And I mean, it was just depressing how poor it was. And it was just like, it was close to zero. And, this included a period, where the GFC happened. And so, the number calling at the beginning of 2007 for, massive problems didn't happen. And so if they can't do that, then the idea that, anyone else is going to randomly be able to predict exactly what's going to happen seems pretty low on my part. I mean, obviously the story has been, there's 6 interest rate cuts that were forecast at the beginning of the year, and now we're sort of saying maybe it's 1 or 2, maybe it's going to be 0, maybe it's going to be a there's 20% chance of a hike apparently. So I just would sort of throw that all in the bucket of like stuff is going to change. I suppose what for a couple of the names that a period of lower interest rates would probably be good for Liberty Latin America. Probably wouldn't matter as much for some of the other names. I think that maybe a period of, if the dollar were to weaken a little bit, just mechanically there might be more money flows into emerging markets, and maybe some people would sort of kick the tires on something like Millicom a little bit more closely, because it looks bombed out, but you just can't predict the timing of this thing. And one of the humbling things about investing is you can be wrong about something, you can be right about the underlying investment, and it just takes a lot longer than you'd like to, for investors or other people to come and corroborate, your story. And that is the, potential risk for, buying some of these smaller names. But I think, with a little bit of patience, I I think these are really interesting situations. But to the underlying question, I suppose that like one thing everyone has to keep in mind is just like interest rates may not fall exactly as we anticipate, and that could have some negative impacts for markets going forward.
All right. Kind of on a related note, what advice do you have for individual investors in the current market environment?
Yeah, I'd probably echo, all the comments I sort of said about like, just be really suspicious about anyone's ability to, predict in any individual, market trends. Interest rate forecasts are very, very difficult. I guess maybe one other thing, it's probably a self-serving comment to a certain degree, but I think it's very possible that the next 10 years don't look exactly like the past 10, and maybe that the idea of it only makes sense to be in the United States. The dollar is always going to be strong. You throw interest rates are for sure going to moderate, not be as volatile. Deficits don't matter as much. Just because something applied for a 10-year period doesn't mean it's going to apply going forward. And hopefully, I think that's the case. Just because banks in Europe trade at very low prices, does not necessarily mean they always will. I would think. So I think it's just it's just human nature. You extrapolate recent events, like all of us do when you predict forecast the company earnings. In many ways, you're kind of extrapolating recent trends in some way, shape, or form, and reality can end up veering a lot from that. So I think that's probably one aspect that I'd sort of flag for individual investors.
All right, thank you. I think that's some great advice. As you know, Charlie Munger passed away in December. What do you think his most significant contribution to the investment community was?
Well, I'm from Omaha, Nebraska originally, and so I joke a little bit that I've owned Berkshire for roughly 24 years, and by Omaha standards, it means I totally missed the boat on what a fantastic story it is. I sort of say, for having attended many of the Berkshire meetings, it's just his incredible, uncommon common sense has been really incredible. I mean, just sort of complicated concepts that he can summarize in a couple sentences. Sometimes one sentence is truly remarkable. I think he's about as close to unflappable emotionally as any investor that you'd ever meet. And I certainly didn't know Charlie Munger personally, and I saw him speak several times, sometimes down at the Daily Journal down in LA. But I sort of think maybe one of the underappreciated aspects was just the incredible sense of humor. I mean, he just was, like what he would say, obviously in a very direct, way, but I don't think he took himself too seriously. He was obviously a brilliant investor, brilliant individual, but he really did just a fantastic job of, making his points with humor on a regular basis. And that was probably one of the aspects I enjoyed most of listening to him. But he's clearly in the Hall of Fame of of investors of all time. And a lot of what he says, you could read something he wrote 20 or 30 years ago, and it would age incredibly well. It would be entirely relevant for something else today.
Yes, thank you. I definitely agree that he has a lot of timeless advice for pretty much any situation. Just to wrap up our time together, whether they are investing related or not, please recommend 3 books and 3 movies for our listeners to check out. And could you also share why you like them?
Yeah. Okay. Well, let me see. I think maybe I'll stick to the books. I'm not as big a movie person in general. My wife would be much better for giving her recommendations. We have enough trouble finding something in common to watch. So I would say, sort of a mix of both. I think from an investing point of view, the Will Thorndike's The Outsiders was fabulous, and for there you can and read about, John Malone, Warren Buffett, among others, who different industries, different balance sheets, and whatever businesses that they started. And and just like, again, super rational thinking, and just extraordinary capital allocation returns that was able to generate. I think from an investing side, that's really valuable. I think, in today's world, I think the chip war, I think it was Chris Miller who wrote that. So it's a very recent book, but I think that's really fabulous for sort of thinking about, and a lot of I am not super strong in, in the technology, area, but a lot of sort of the history of semiconductors and what the applications, how that, industry grew over time, how it was threatened, near extinction in the U.S., and then, how it expanded again, and, all the offshoots of Texas Instruments, and a lot of the applications, and how it affects geopolitical events, and, the military's use of technology over time. And there's a lot of topics that are sort of covered, and, just about, something on, something, I guess, like a theme of semiconductor, something closer to like what maybe oil used to be, et cetera, I think is really worthwhile. Sort of an older one. I thought The Smartest Guys in the Room, the Enron story, it's sort of a timeless book, and it in some ways, it's easier to read about someone else's failures in some ways rather than try to experience them the same. But obviously it's specific to Enron. It was complicated accounting, but like a lot of, I think some of the lessons are applicable for sort of what happened in 2000, really most recently 2021, 2022, with just excessive valuations, sort of how a story can be pulled over. A lot of very smart, rational people are just so captivated by a story, they suspend reality in some way, shape, or form. And I think Enron, it might be, that might have been a slightly different in the sense of, off balance sheet accounting entities, and how they, were able to manipulate earnings in many ways. But it was more just the story of just like people wanted to believe this is a radically different, energy company that was going to be able to take on, these enormous markets, and just how many people believed them. I think it is pretty applicable across maybe some areas where investors should be a little skeptical today. And maybe along the modern version of it, I mean, if you place like, The Smartest Guys in the Room with, Going Infinite, Michael Lewis is obviously one of the more entertaining writers of all time. And, again, it's like, I'm not the person to speak with on Bitcoin. I can barely even describe what it is, but like, I probably have a negative bias towards it, but like, following that, Sam Baker-Fried's around for a bit, and Michael Lewis, the way he can bring a story to life, it's just incredible. And I mean, I highly recommend that. And I mean, it's just like you see some of the headlines, etc. And I mean, sort of want to follow this from a, just having a good laugh as well. I think that's outstanding. And, for those who want more, something closer to, straight investing, I still would, Larry Cunningham's, Warren Buffett letters and his, insights with the underlying writings that have existed over time is certainly, a fantastic bet. And I think a lot of those are timeless. And, I think you could really get, something akin to, I don't know if it's an MBA or like, some sort of like, honorary finance certificate, just going through all those letters that have been written. But I think those are highly valuable. So I'd recommend those as well.
All right, those all sound like great recommendations, and I'll be sure to check a few of those out that I'm not familiar with. But thank you again so much for joining us, Patrick. It was a pleasure to have you.
Great. Thanks a lot for the opportunity to present. I appreciate it. And please, if anyone has questions here, they can follow up with me after going through this presentation. Thanks again for your time.